Hey, what's up, my friends? So in today's training, I want to share with you the 3 golden rules that you can't afford to ignore when it comes to candlestick patterns. Number 1, alright, don't trade candlestick patterns in isolation. So what do I mean by this? So let's say, for example, right, market is in a downtrend, right, like this, okay? Then the price forms over here like one bullish hammer that looks like this. And many traders will look, oh, Rayner, look, it's a bullish hammer. It's time to buy because that's what the textbook says. Hammer means buy. Hammer is bullish. So what's the problem with this? Well, the problem with this is like you can think of the bullish hammer, right? Like a Toyota car moving at 50 kilometers per hour. And on the other side of the road, it's this bullet train moving at 200 kilometers per hour. When the two of them meet, what happens? Well, likely the bullet train will just, ram the Toyota into pieces and, get crashed, right? And it's the same thing as this chart I'm sharing with you over here. It's like, the hammer is like the Toyota. This downtrend is like the bullet train. What's likely to happen is that the downtrend is likely to continue and it will smash, right, that hammer down lower, right? So don't just trade candlestick patterns in isolation because it's a recipe for disaster. I'll share with you later on what you should do instead. But the second thing to let you know is this. Avoid chasing, right, a series of large range candles. So again, a common mistake that I've seen is that the market is bullish, right? So it breaks out higher, 1 candle, 2 candle, 3 candle, and then traders, they start to have the fear of missing out. Man, Rayner, the price is so bullish, I better get on board this trade now, lest the price takes off without me. Well, here's the thing, right? Whenever you look at a chart and it looks really bullish, more often than not, right, your gut feeling is wrong. That's usually a bad time to enter a trade. So let me give you a few examples. So if you look at this chart over here, so you can see over here, at this point, right, price is bullish, right? Bam, 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 3 big bullish candles in a row. Market is going through the roof. Well, guess what? That's where the market starts to make a pullback or even reverse. So you can see, look back over here as well. Bullish, 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 bullish. Bam, we face the pullback. Okay, so this one here, bearish, right? Bearish, bearish, right? Bam, pullback. So here's the deal, right? When you see a series of large candles, right, moving in that one direction, usually, right, it's too late to enter the trade already. So just stay away, right, from such a price action that you see. So another example, you look at this, 3 bullish candles in a row. What should your thought process be? It's not to chase, not to buy this market, but it's to stay away from it. So the first 2 rules that I've just shared with you are things that I want you to avoid doing. So how should you trade candlestick patterns then? Here's a very simple formula for you. This is what I call the TAY formula. It stands for number 1, you look for the trend. 2, area of value, and 3, entry trigger. So in other words, right, what you're looking for is for the market to be first, let's say, trending up higher in an uptrend. Okay. Second thing, you're looking for the price to come towards an area of value. This could be things like an area of support, a swing low, a respected moving average. So let's say in this case, you come towards this area of support. Okay, come to this area of support. Then the third thing you're looking for is an entry trigger. So this is where your candlestick patterns knowledge come into place. This could be a bullish entry trigger like a hammer, a bullish engulfing pattern. So let's say in this case, we got a hammer. Something like this. Okay, so when this happens, right, we have the TAY formula conditions are met because we have the trend, uptrend, price is at this area of value, okay, and we have a valid entry trigger to go long. So let me give you a few examples, right, on how this looks like. So this is the chart of Cloudflare. It's a stock. You can see that this market overall, it's in an uptrend. Okay, so just put here, arrow here, uptrend. Number 2, you can see that this market came towards this area of value, right? It's an area of support, right? Support here, tested once, twice, and then we are back here for a third time. The third thing that we have is a bullish entry trigger. You can see that you have a bullish hammer over here. Okay, and the next candle is again another bullish price rejection. So you can see that how this is different from chasing the markets, how this is different, right, from trading candlestick patterns in isolation. You're actually waiting for numerous conditions to come together to help you find, right, a higher probability trading setup when you're trading candlestick patterns. Of course, there are more things that you can look at, but I would say this simple framework is good enough for you to get started. So here's one more example, right, of the TAY formula. So you can see this one over here. This is the Houghton Mifflin Harcourt Company. What a long name. But anyway, first thing, the TAY formula. Number 1, stock is in an uptrend. Number 2, we're looking for it to come towards an area of value. So in this case, price came towards this swing low over here. Number 3, it forms a bullish entry trigger over here. I think I covered it a little bit. Let me just remove the lines. You can see we have a bullish entry trigger. This one is in the form of a I'm not sure what is the exact name of this bullish candlestick pattern, but you can see that it's bullish, right? And we are not just trading this candlestick pattern in isolation. We are trading in the direction of the trend from an area of value, and then we have this bullish entry trigger to signal to us that it's time to enter a trade. So looking back a little bit, you can see that we have another setup over here, this one, okay? Price came towards this area of value. we have this bullish price rejection over here, then the market, continues up higher. Of course, the charts that I've just shared with you, they are all cherry picked, but the main point is to illustrate, right, the concepts that I'm sharing with you, and I want you to go and do your work, validate the concepts that I've shared with you, and see, if it works for you or not. So a quick recap: number one, don't trade candlestick patterns in isolation. Remember the Toyota against the bullet trade. Number two, avoid chasing a series of large range candles, because by the time, right, the market is usually ripe for a pullback or even a complete reversal. The way to do it, right, is to go with a simple formula, what I call the Tay formula, looking to trade in the direction of the trend from an area of value, and then look for a valid entry trigger to time your entry. So with that said, I hope you enjoyed this short training tutorial. If you do, smash the thumbs up button. If not, then hit subscribe. I'll talk to you soon.